There have been three big changes to investment taxation this year: the introduction of the personal savings allowance, the introduction of the dividend allowance and higher rates of tax above that, and the reduction to capital gains tax rates. How, if at all, do these changes affect corporate investment? The personal savings allowance doesn't, because it's personal, it's not relevant to companies. The dividend allowance also doesn't affect corporate investment. It's £5,000 worth having, but it's only available to individuals. For companies, dividends are and continue to be, and have been for some time, tax-free. Dividends received by a UK company from a UK collective investment or UK equities are tax-free in the hands of the company. So if we're thinking around investments where there's a strong dividend yield, a company investing in UK collectives can invest without any tax being paid on that dividend, regardless of the level of that dividend. If the dividends were received inside a UK life bond, if you were thinking of tax deferment, you probably won't get it. FRS 102, the new accounting standard, pretty much does away with historic cost basis and instead really means that every company will then be looking at the loan relationship rules applying to investment bonds. So if you're investing in collectives via an investment bond, you're going to get no tax deferment because the growth in the investment will be taxed each year. So let's have a look at capital gains tax. Well, companies don't pay capital gains tax. Companies pay corporation tax on capital gains when they realise them. Number one, they only pay tax on gains above indexation, so on real gains. And the measure of indexation is the retail prices index, which tends to be a little higher than the consumer prices index, even though neither of them are that high at the moment. It's a fact, it's still worth having. And also it's worth bearing in mind that the corporation tax rates have fallen quite dramatically over the last few years. They're going to fall again in 2017 to 19% from the current 20%. And then in 2020, they're going down to 17%. So the fact that companies only pay tax when they realise gains, as do individuals largely, and only pay tax on real gains, and the corporation tax rates are so low, together with the fact that they pay no tax, companies, on dividends received from UK collectives, makes the UK collective look a quite tax appealing and very tax clean investment for them to make. This whole subject of corporate investment is quite a fraught one, very difficult one, especially given these new accounting standards. I'd recommend that you read the Techlink chapter, the library document on corporate investment, to get a lot more detail with some really detailed examples on this subject.